got a lot of Sweden on the show today. Atlas Copco is Darren's first idea, huge in air conditioning, stuff like that.
Yeah, so I think thematically what we're looking at is 3 to 5 year investment time frame, and we're looking to take advantage of dislocation in currencies and obviously valuations in Europe particularly. So Atlas Copco is a global leader, very asset-light business model, high 20s to low 30s return on equity, so very high, and a serial tuck-in acquisition company that has 4 verticalized businesses. And history has shown that if you don't buy it when it's on sale, it's a mistake. So very well-run company. I probably would regard it as the best capital goods company in Europe from a management point of view. And it's basically everyday Canadians every day are bumping into its products, whether or not they know it. For example, when you get your tyres changed in the winter, they probably use the vacuum machine to take your tyres off. Industrial applications, pneumatic drills, clean rooms, lots of different things. So growing dividend and a very attractive valuation at these points. And it has retraced, but it could retrace a little bit further here. But if you look through a Canadian currency lens, very attractively priced.
Yeah, I said air conditioning. I don't know if that's a big, but it's compressed air, industrial gases, stuff like that. Yeah.
Correct.
Your next idea, I'm going to make a mess of this pronunciation. It's in Finland. Finnish, a very simple language to learn. Kuna, what do they do?
Yeah, so I mentioned this in the past. So we've owned this for a period. We actually sold half of this position last year at 70 euros. And then lo and behold, Mr. Putin invades Ukraine. We have currency issues in the Eurozone. We also have obviously valuation resets, and there's obviously a recession. Now, Kone is the global number 1 or number 2 elevator and escalator manufacturer in the world. 50% of revenues are recurring, and they sit on excess cash, about 3 billion Canadian worth of excess cash. The stock is down meaningfully. So we think, again, over the next 3 to 5 years, this is going to improve. The next natural catalyst will be when China exits zero COVID as it is the largest market shareholder in China. So very depressed pricing, very, very strong balance sheet, attractive dividend, and over a 3 to 5 year period, you're going to get rewarded, and the dividend is safe because there's substantially more cash than there is liabilities.
They're big in those moving walkways that they used to shuttle you around airports.
Yeah, and you'll see it. And if you go to hotels, you'll see the name K-O-N-E. You'll see the name on elevators now that you've been told the name. But otherwise, you might not even recognize it. Big penetration in Canada as well.
And then finally, Enbridge. Of all the stocks in the world, Enbridge is one of your favorites.
Yeah, so you're obviously gonna pick we aim to pick national champions. We aim to pick best of breed companies, but we also want to have some Canadian content in our names. Obviously, Canada is part of the global universe, and if you look at the dividend track record in terms of growth, you look at the renewables pivot. You look at the underlying opportunity for growth, and I think you also need to take a position on whether or not you think that carbon-based energy is going to continue for the foreseeable future, and we do. So with that view in mind, we think there's dividend growth potential. We think it's attractively priced, and it's another proxy way, perhaps a more safe utility-like way, to get exposure to carbon without actually having to go into the development side. So it's a good story. It has rewarded Canadians very well for long periods of time. It looks attractively priced here. So for that reason, we think it's appropriate to add to the portfolio. And we own it, and we like it.
I mean, we here in North America are commodity producers. This war is a windfall. I know that's a callous thing to say, but it's pretty good for energy producers in this part of the world ultimately.
Yeah, so if you look historically, what performs very well during a recession, the number 1 category tends to be commodities. And it can be metals or it can be energy. So you want to have some exposure there. Obviously, staples and pharma are the other categories. So we have lots of that. So really, this gives us an opportunity to participate in inflation. This is going to transpire and pass through the system. And an attractive entry level. We do have some energy providers. Equinor I mentioned previously. This is another way to do it, but to do it in a more contracted take or pay type contract structure, which leads to sustainable cash flows and dividend growth. So that's what we like about it, and that's why we want to hold it and have it as part of the portfolio.